something really crazy happens, we can all expect a Fed rate hike when the Federal Reserve meets later this week. And in an environment where interest rates are rising, investors tend to flee from high-yielding bond market alternative stocks like the real estate investment trusts. The REITs have been in a house of pain for months because their yields became a lot less enticing as rates creep higher. However, there's at least one REIT that seems to have been bucking the trend. I'm talking about DCT Industrial Trust. The symbol is DCT. It's a company that owns bulk distribution warehouses and light industrial buildings with a stock that's only $3 off its highs at these levels. It's giving you more than a 25% return in 2016. In a way, DCT is somewhat of a play on e-commerce. The more people shop online, the more warehouse space is needed to store that stuff, whether it's in transit or waiting to be in transit. The company reported a strong quarter a little over a month ago with higher than expected revenues and funds from operation. Plus, management gave really robust guidance to developing a number of new properties to allow the business to keep growing. So is this the kind of REIT that is safe to own in a rising interest rate environment? Let's take a closer look with Philip Hawkins. He's the president and CEO of DCT Industrial Trust. Find out more about his company and its prospects. Mr. Hawkins, welcome to Mad Money. Good to see you, sir. Have a seat. Thank you. So it's been 10 years. You're a growth company that happens to be a REIT, and it seems like that to lump you in with companies that are just interest rate sensitive is a mistake, given how strong your business is and how much you've got ahead of you.
Well, it's been a great business to be in, and we're so fortunate. And I think what I would encourage investors to do is not look at interest rates, but look at the underlying business. And as we go into this environment with a rising economy and accelerating growth, that's good for our business. Our business is focused on U.S. consumption. The better U.S. consumption is, the better we'll do. We've done great in a slow growth world, but I'm looking forward to a high growth world too.
Well, I know at one point in your conference call, someone said, look, is there supply coming on? And because you've been able to raise rates pretty regularly. You said, well, there is supply coming on, but the demand is so much better that we shouldn't worry about the fact you'll be able to get some rent increases.
You know, two comments. Demand has been spectacular, robust, broad. You know, e-commerce, as you mentioned in your opening remarks, has clearly been a driver, but really it's across all sectors. The consumer, branded consumer companies, housing's has helped kick in. Every company is investing in the supply chain right now to, one, make it cheaper and faster, and also accommodate growth, which has been great. The thing I worry what you worry about is demand, supply. I mean, supply.
Right, supply, and there's not enough, right?
And you know what? And supplies remain disciplined for a variety of different reasons. But we have been in an environment for now quite some time where demand has far exceeded supply, and I think that's going to continue for a while.
It seems like when you're doing these infills, you're 96.2% your rent rolls are really incredible, and they're up year over year. But it seems like that you do these places that are near urban areas, which is, again, part of what Amazon needs and what FedEx needs to get to us that stuff the next day.
Well, you know, everybody wants to be closer to the city.
Right.
And, you know, one thing about real estate, it's supply and demand. And to me, we've been trying to focus our portfolio where the demand's the greatest, but also it's hard to build supply. You want to be to make money in real estate, in any sector, but certainly in our business, you want to be in locations that are hard to replicate, where there's not a lot of land around. And that's what we've tried to focus our capital and our time is finding those locations, buying buildings, and building new ones.
Okay, now on your conference call is November 4th. Someone asked you on the call, are you seeing people accelerating decisions or are they putting them off? That was right before the election. How about since the election? What have things been like?
You know, I would say no change.
No change?
No change. I think that we're in such a robust environment. Our customers continue to make decisions. It's been a great environment, and I think it's going to continue for a while.
Now, it's been 10 years. I noticed that you shuffle, that there's some properties that you decide to get rid of and other properties that you buy. It looks like some of the properties you buy have lower rents than are the market, and you can raise them over time.
Well, again, it's back to looking for opportunities to grow.
Right.
And growth is important to us, and both growth in value and growth in cash flow. And so we're focusing on assets that we believe will be in locations where we can raise rents and where we'll have good, broad demand. And then we're selling assets that we've either fully realized the value opportunity, or where we may believe that rents may not grow as well as the rest
not
of the
as robust. All right, now, some consumer brands that our viewers are familiar with because we like the stocks, Smucker, Stanley Black & Decker. Now, when I see them as large consumer brands, what are they using you for?
Well, distribution warehouses, and they're, Black & Decker, for example, a lot of that warehouse is used for e-commerce. They're fulfilling e-commerce orders out of there in addition to fulfilling their customers' store, their stores.
And does UPS, FedEx, Amazon, are they all renting space? What do they do?
They rent from us.
They rent from
you.
They
also, no doubt, own. I'll give you an example, two examples. Both FedEx, we had a 50-acre parcel we assembled over a period of time in Chicago, right by Midway Airport, just outside of the city, as close in as you can probably find, 50 acres. And it was 3 different sellers. We aggregated that parcel and started with plans to build normal distribution. FedEx came along. They probably would have rather bought, but it's not for sale.
Right.
And when you got something somebody needs, the result was we entered into a long-term lease with FedEx. Similar with UPS, we had a property in Hayward. It's a building that was vacant when we bought it. Right. It was a good building, but it was too big for the site. There wasn't enough parking for trucks or for cars. And as soon as so our plan was to demolish a quarter of it to create more room. We essentially added value by subtracting brick and mortar.
Oh, well, look, to me, it sounds like something like that. Business is good enough that you can do that.
Well, you want to do that.
Right.
Our goal is to create value, not just buy and hold, but buy and add value through our people and through our ideas and through our capital.
Well, it certainly worked because you've had the better return than almost every real estate investment trust that I follow, and I want to congratulate you because it's a great growth model. That's Phil Hawkins, the president and CEO of DCT Industrial Trust, doing really well and not a bond market equivalent. It's just a growth stock. Mad Money's back after the break. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.